Hi, welcome to the channel. Now today I want to answer a question that I received. And that question is, when I have a cash value life insurance policy, when the insured dies, does that beneficiary get the cash value in addition to the death benefit? Great question. The short answer is no, but here's why. So when you design a policy like this, you want to design it so it's efficient and cost effective. So when you have your premium dollars, when you pay your premium dollars, your dollars is going into two buckets. That's to build cash value, which is paid up life insurance to have build cash value, as well as the cost of the death benefit. So you have building the cash value and you have the cost of insurance, the death benefit. Okay? Everything associated with paying the death for the death benefit. If all your premium dollars was going here, it would be very, very expensive. But and the cash value will take a long time to build up, because then you're not dumping any money into the cash value bucket to accelerate that growth. So it's going to be a slow growth process. So policies that designed with cash value with a slow growth process is mainly the interest that's growing the cash value, and with no money going over there, really, it takes a while to build up. And you're paying for the death benefit, which is expensive. So let me show you how that would look. So for example, just so you have an understanding, for example, let's say a person is 70 years old and they have a death benefit that's $1.2 million. Okay, 70-year-old, death benefit is 1.2 million. Let's say the cash value is $1 million. The cash value has to be below the death benefit until there's a maturity, and when it matures, then it becomes the same. I'll explain that in a minute. But your cash value stays is going to be usually at least 5% less, or more, depending on where in the growth process it is. But let's say, for argument's sake, this is 1 million here. So when you structure a policy like this, what you as a policy owner who's paying for the policy is responsible for is what's called the net amount at risk, right? So in essence, your cash value becomes part of your death benefit. So now you're only responsible for paying for the net amount at risk. So the death benefit here is $1.2 million. The cash value is $1 million. So you would be responsible for $200K. So you're paying for $200K of insurance. So at 70 years old, instead of paying for $1.2 million of death benefit, you're paying for $200K, right? The net amount of risk, because your cash value counts as part of your death benefit. This way, your policy is not expensive. At 70 years old, paying for $1.2 million of life insurance is very expensive compared to $200,000. All right, so this is how you keep the costs low and minimize the cost. And the death benefit, another part of the question was, do you get a level death benefit? Now, the death benefit, when policies are designed like this, doesn't stay level even if you choose level. Why? Because of the growth of your cash value. Your cash value is growing, and your death benefit has to grow with it when it grows, right? So your death benefit is not going to stay. It will stay level for a period of time. But as your cash value starts to grow, eventually your death benefit has to grow because the insurance company has to be on hook for some kind of death benefit, right? Until the policy matures. So, let's say it started out as you're paying for $500,000 worth of life insurance and your cash value grows, and when it catches up close to it, now that $500,000 of death benefit is starting to go up as that cash value keeps growing. Because remember, with time, with continuing to pay your premium, having cash value goes into that bucket when you pay your premium, and also the interest that you're earning each year. Because remember, you're earning interest as well. So your cash value is a combination of the paid up insurance that you're paying when you pay your premium, in addition to the interest that's growing. So it's going to grow over time, right? And as it grows, and now it's catching up to the death benefit, your death benefit has to keep going up, And that's the process that's going to happen eventually until the cash value meets the death benefit, and they're the same. That's when the policy matures. So the policy matures in two instances. A, the insured dies. Or B, to the expiration of the contract. So even though it's a permanent policy, it does have a expiration. In the past, 100-year-old was when it's done. So what does that mean? That means when you reach 100, if you're still alive, they're just going to pay out the death benefit. They're not going to wait till you die, right? In most cases today, that number is larger. So people living a little longer than way back in the day, so that number is moved up to 121. Now it's a lot less likely for someone to live to 121 years old, right? But if they did, God forbid, they stayed healthy and they're able to live that long, then the insurance company will pay out the death benefit at that time. But again, that's very least likely to happen. So when the insured dies, they're going to pay out the death benefit. Automatically at that point, the cash value and the death benefit becomes equal. So it's paid out. So that's why you only get paid the death benefit. Whatever the death benefit was, that's what it is. And if you don't die before you reach 121, then they'll pay it out then. But that's why you don't get paid both. Because imagine having to pay enough that you're dumping money into your cash value, as well as paying for the full amount of the death benefit. That would be very costly. That would not make sense. If you work out those numbers, that just would not make sense for a person to do that. No reason to do that. So you're just paying so much more money so you can have both. Just wouldn't work. It just wouldn't work. Right? Because let's say in the example I gave was the 1.2 and 1 million. In order for that cash value to reach up to 1 million, and you're paying paid up addition, right? That's a lot of extra money that you're dumping over here. Plus you're paying for the full amount of 1.2. So you're, in essence, that's 2.2 million. That would be very expensive. Nobody would want something like that. So that's why it's structured in a way where while your cash value is building, you're paying paid up addition that's dumping into it, minimizing your cost of your death benefit, so the policy is not very expensive, but you're still getting that benefit of having a large death benefit. And now you're only responsible for the net amount of risk. So in a case like this, when it's structured correctly, you can actually be paying a lot less at an older age than when you were younger, which is the opposite of how life insurance really works, because as you're older, the cost of insurance is more, but because you're only responsible for the net amount of risk, which is the difference between the cash value that's built up and the death benefit. So when that number is very close, I showed a 200,000 difference here, but the difference could be 100,000 or 50,000. Imagine only paying for $50,000 of life insurance, and you have a death benefit of 1.5 million, 2 million. So that is the benefit of having it structured and designed that way to keep it efficient and cost effective. Hopefully that was helpful. Hopefully that answered the question. If you do have any other question, please let me know. If you do like the channel, do like the information that's given here, make sure you like, subscribe, and hit the notification bell so when a video is released, you're one of the first to be notified. Until next time, see you soon.